including today, to finish up chapter 6, and I can tell you that it won't, like, I'll finish with the lecture today. So we can go through some practice problems, and then I know I've got down here to review for the comprehensive and assessment exam, so we can probably take the entire period for that on the 5th. If you haven't already started the homework, start the homework, because then we can go through, you can bring questions and we can go through them together, okay? So, and let's see, so our, again, so the, on the 7th is when we're gonna do the comprehensive exam. This one is, so you do take it in class. It's 60 minutes long, so, and we've got the whole period to take it, so you'll have ample time to do that. There are 50 points possible on that. Like I said, we'll go ahead and review. I do have a study guide, which I think should be accessible to you. Maybe it's not open yet. I know I still have a couple of things to set up. No, okay, so sources, well, let's just make that accessible to you, shall we? Although the lecture, let's see, the lecture part, let me make sure this just isn't my online class here. This lecture part was from last semester, spring semester, but we used the same material, the same book and everything. But, so it's there for you to view. Assessment, payroll. Oh, you know what? Some of this I'm not going to make accessible. I want to look at that first to make sure that. So I'm going to give you the study guide to make that accessible to you for both of these. Yeah. We'll publish that. I want to take a look at the videos first. I don't want to give you access to stuff that's maybe not relevant for you. I'm still not 100% sold on Canvas, I'll tell you. So yeah, I'll take a look at those videos and see if they're worthwhile to publish them. Otherwise, we'll just do those reviews in class. And then the final exam is a take-home exam. I'm trying to get my bearings here. Is a take-home exam. So we won't actually meet during class to take that, but you do have a due date of December 12th. It is open book, open note for the final exam. Okay. So again, that'll be due by Tuesday the 12th at 11:59 p.m. And what else? So it's just the that comprehensive assessment exam that's going to be here in class. Any questions about the schedule coming up? Yeah, go ahead.
Is the comprehensive course, is that just like every other one in an accounting course? Okay.
Yeah, same sort of thing. I think it's like 30 questions, multiple choice. There might be some true false in there.
Does that add to our grade here?
Mm-hmm.
Okay.
Yeah, I count it for, I give you points for it. Yep, because I want you to try.
Yeah.
I tried that at first when we started giving these. I did it, you know, I actually did it as extra credit, and then the students really didn't try they didn't study for it, so I do want you to actually try. Any other questions right now? As we get closer, we'll talk about it more. But then, so today, what I want to do is, so we were talking about those journal entries, those 4 journal entries that we have to record. We will review, I think we just got through the first couple of journal entries. But we'll do some review on those, go through those a little bit again, just to kind of refresh your memory since it's been a while, been a week and a half. And then we're going to look at the other two journal entries, the one that we record when we actually pay the payroll taxes, and then the one that we record at the end of the accounting period. So recall, we have 4 journal entries that are made pertaining to payroll. Now that doesn't mean that, I should say there are like 4 classifications of journal entries that are made pertaining to payroll. It may be that you're making journal entries every day. If you're paying employees every day, then those journal entries are going to have to be made every day, right? And you'll probably be making this payroll taxes entry multiple times a month. So don't think that like every month we only have 4 journal entries that have to be made. It's just 4 different types of journal entries that are made with regard to making those recordings in the financial statements for payroll expenses, liabilities, and that. So that third one, when the payroll taxes are paid. The fourth one then is, I thought that was spelled wrong. I looked at that and I was like, that doesn't look right. It's not right. It should be an S, not a C. And then the fourth one is made at the end of the accounting period. So these first 3, some sort of cash transaction has occurred, right? The first 2, the cash transaction that has occurred is we paid employees, right? So that's the trigger, is we paid employees, so now we've got to make those first 2 journal entries. The third one, again, we have to make some sort of payment. We're going to pay the payroll taxes that we owe at that point. So that's the trigger. We have to make a payment, then this journal entry is going to be made. The fourth one, though, there is no cash transaction that occurs at that time. The trigger is it's the end of the accounting period. Whatever that accounting period may be, it might be the end of the month, might be the end of the quarter, might be the end of the year, whatever the end of that accounting period is going to be the trigger for that 4th journal entry. So we already went through and looked at the first 2. And remember, we get this information from, where do we get this information from for these journal entries? What records do we use to get that information? Employee earnings record, right? And mostly the payroll register, because these are going to be summaries of the entire payroll, right? The entire gross payroll is going to be our debit in that first one, and then the amounts that we withheld from, total amounts that we withheld from employee paychecks, and then the total amount of cash that we paid, those net paychecks, is going to be our credit in that one. Payroll taxes, these are the amounts that the company owes, the company's share of those taxes. But we would extract that information from mostly the payroll register. If we're just paying 1 employee, then we could use that employee earnings record as well. But that's where we extract that information from. Paying the payroll taxes, we're not going to get that information from the employee earnings record or the payroll register. We're going to get the information from the accounting records, because we know how much we owe, and then the date that we owe it is going to be based upon what our payment schedule is, right? And then this last journal entry, these amounts, that journal entry, you're going to have to work with the accounting department to determine what that journal entry should be. Actually, the accounting department is going to be making these journal entries, but the information is going to have to come from the payroll department in order for them to make those journal entries. And so even this last journal entry, wages and salaries, expense, I'm going to have to change that because that's bothering me. That information is also going to come from the payroll department, probably in conjunction with the other individual departments within the company, because what we're doing with that last journal entry, sorry, I'm trying to do 2 things at once here. what we're doing with that last journal entry is we're recording the amount of wages that we owe at the end of the or at the end of the accounting period, but that have not yet been paid. Okay, because remember, we've got to, for accounting purposes, we have to match our expenses with the correct period, whether or not we've made that payment yet or not. You know, that's the basis of accrual accounting there. So let's take a peek again at let's do a little review of these first couple of journal entries, and I'm going to pull up the slides once more. Actually, there we go. All right. So again, this is what our payroll register would look like. We would extract the information, the total information here from this payroll register in order to make that first journal entry. So in this case, our debit is going to be an expense, wage expense, and it's going to be for the gross amount of payroll. So the total payroll before anything has been withheld. So, and again, these accounts may have different names. The most important thing is to remember that this is an expense account. So in this case, our expense is $1,845. And then the rest of these, so that's our only debit for this first journal entry, is that wages, that expense. And then our credit is going to be all of the liabilities that we have incurred, so the amounts that are being withheld from employee paychecks, plus the amount of cash that's actually going out and being paid in the form of paychecks, net paychecks, to those employees. So we would have, and these are all payables, so OASDI payable. They have HI here, we'll use their terminology. HI payable, these are our credits here, debits here. Federal income tax payable and state income tax payable. We've also got insurance, probably a payable, and cash. Remember, all of these then have to equal our 1845. So 11439, 2675. And you know how to calculate all of this stuff, right? You'd be able to calculate it. Of course, with the federal income tax, you'd have to know what is on that W-4 in order to calculate it for each employee. But you know how to calculate that. State income tax as well is going to be based on whatever state that you are in. So 170, 50, 191, right? And then our net paycheck's 1292.86. And to double check it, you'd want to make sure you'd want to add all of these up and make sure that they total $1,845. Because both sides have to balance. Debits have to equal credits. So that's the gist of our first journal entry. Now, we may have additional payable accounts here, right? Any voluntary or involuntary deductions, anything that's been withheld from the employee's paycheck, we're going to have a payable account for that item. So if we've got child support that has been withheld, we'd have some child support payable. If we have retirement contributions that have been withheld, we'd have retirement account payable. right? But these are all amounts we're withholding it from the employee paychecks that are then going to be paid to whichever external agency that we're paying it to. Questions about this first journal entry? Pretty clear? All right. Where are we here? 26. So there's our journal entry. Now we look at the second journal entry. And again, this is made when we actually pay the employee. A single employee at, in a payroll that's outside of the regular schedule, or if it's the regular schedule, whatever. Every time an employee is paid, these two journal entries are going to be made. So the second one is to record the amount of payroll tax expense that the employer incurs. So that portion of the employment taxes that are the responsibility of the employer, right? And again, you can calculate this. You know how to calculate this. So that the OASDI is going to be that 6.2%, the employer's portion of that. FUTA wages, remember, up to $7,000, the first $7,000, most likely it's going to be 0.6% of the employee's wages. And then the SUTA wages, again, is going to vary depending upon the state that they're operating in. But you know how to calculate all of that. All right, so you've done your calculations. The second journal entry that we're going to make, we're going to debit our payroll tax expense for the total of all the payroll taxes that we're paying. So again, this is an expense account, and you would want to make sure that you're calling it payroll tax expense, because as we discussed a couple weeks ago, companies pay all different types of taxes. They pay sales taxes, they may pay income taxes, they pay property taxes. So you want to distinguish what type of tax that is, that payroll tax expense. That is our debit, and it would be the total of all of these. So they didn't total it up here for us. I'll get the amount over here so I'm not. So 190.89, and that 190.89 is just the total of all of these added together. And then our debits are still going to be payables. Okay, so these are amounts that we haven't paid them yet, but we will have to pay them in the future. So we've got our FUTA payable, SUTA payable, OASDI, let's see, HI wages. Now they haven't given us the OASDI or the HI here, but it's going to be the same as what the employee had withheld, right? So our OASDI payable is still going to be that 114.39. Our HI payable 26.75, and then they've done the calculations for us here on the FUTA and SUTA. So FUTA 369. And SUTA 4606. All right, and again, all of these should equal our 190.89. Okay. So that's the second journal entry. Let's see. Any questions on that second journal entry? All right, so let's take a look at this. So Cronus Chemicals is liable for a FUTA tax of $1,200. what is the journal entry to record the FUTA taxes payable? Well, if we're recording the payables, our FUTA taxes payable is going to be the $1,200 credit, right? So the only one here, well, credit FUTA taxes payable, credit FUTA taxes payable. So we know it's going to be one of those two. Our debit is going to be to that payroll tax expense. Here they didn't include the word expense, but that's our payroll tax expense. The answer here would be C. And that would be what the journal entry looks like. Questions about that? All right. So as you learned in your principles classes, once we make those journal entries, we then have to post them to our ledger accounts, right? We need to extract the information that was from our journal entries in order to post it to those ledger accounts. So let's take these journal entries. I'm going to write them back up here. I should have kept them up here, but all right. So journal entry 1, put them over here. So we got wages expense. Was 1845. And FICA. Payable. Oh, I'll do OST payable. And this is actually how they have this here too. Employees federal income tax payable, that's a good idea, because how I have it here, federal income taxes payable, that could be the company's income taxes, right? But it's not, it's the amounts that we have to pay to the IRS on behalf of the employees. SIT payable. And got insurance payable. Cash. So 1845, 11439. 26. 70. 1292.86. Okay, I'm going to stop with this one. I'm going to put the other journal entry up here after we post these to the T accounts. So remember, each one of our accounts is going to have its own T account, its own ledger account, right? So we've got here wages expense. Abbreviate that. FICA taxes payable. Oh shoot, do it again. Let's do OASD. Okay. HI payable. Insurance. Now, they haven't called this, they've called this withholding because of the timing. Usually what happens with health insurance is that the company pays the premium at the beginning of the month before they've actually even withheld from the employee's paycheck. So because it's already been paid, they're not calling it a payable account. Just for the sake of, to keep the terminology kind of the same, I'm gonna call it a payable and pretend that we still have to pay that amount, okay? Insurance payable, and then we got cash. Okay, so then all we do is we transfer these amounts into the correct T account as a debit or a credit, depending upon if it's a debit or a credit in the journal entry. So wages expense $18.45. OASDI payable, this is a credit. $26.75. Payable $170. Payable $50. Payable $191. And cash $1292.86. Okay, so assuming that we had zero balances in everything, and I hope we didn't have a zero balance in cash to start out with because we needed that cash in order to pay our employees. But assuming that we had no prior balance on any of these are our journal entries. These are our account balances currently. So right now at this point in time, we owe $170 for federal income taxes. We owe $50 for state income taxes, we, the company. We owe $26.75 in Medicare taxes. We owe $114.39 in Social Security taxes. We've already paid, this expense has already been recorded. We don't owe that in the future. We've paid it now. And we owe $191 in insurance. And if we had a zero balance, we are now negative $1292.86 in our cash account. Obviously not a good thing. Next journal entry, then, which I'm going to make here. So, second journal entry. So, payroll taxes. Expense. $190.89. Food and taxes payable. Pseudo payable. OASDI payable. And Medicare payable. So $369. I know I'm kind of crunched here. $46.06. $114.39. And $26.75. Okay, so there's our second journal entry, and we have to do the same thing again. We've got to post those amounts then to our ledger accounts. So we do the same thing. We transfer them over. Now you'll see we've got some new accounts here that we didn't have before. We've got our FUTA and SUTA because the employee doesn't pay any portion of those. So that first journal entry, we're not going to have anything to post to those accounts because remember that first journal entry is only for the amounts that the employee has paid. But we do have the employer's portion of the Social Security and Medicare tax. So we could start out with those. So again, we've got a credit, so $114.39. Medicare $26.75. Now we've got these new T accounts that we have to create. So payroll tax expense, FUTA payable, and SUTA payable. So we do the same thing here. So $369, $46.06, and payroll tax expense of $190.89. So we've entered our journal entries, made our journal entries, and then posted those entries to the general ledgers. Those general ledger accounts. Now, at this point in time, we've got some additional amounts that we're gonna owe at some point in the future, right? $369 for FUTA, $4606 for SUTA. We've recorded this expense of $190.89. Our payable, total payable amounts here, we would add those two together, and that's the total amount then that we owe at this point in time. So what do we have here? 878, 5350. So right now, that's what we owe for Social Security and Medicare taxes, and these are the amounts that we owe for everything else. We've recorded, we're negative again, still negative on the cash. So, okay, questions at this point? So right now we haven't, the only payment that we've made is to the employees. That's it. We haven't made any payments for taxes yet. This is the only amount that of cash that's actually gone out. So when we actually do make the payment, let's look at those journal entries. Oops. All right. So again, we're going to have more cash that's going out because we're actually going to make a payment. Hopefully we've had some cash come in that we can use to pay those amounts. But we can then look at our balances at this point in time to determine what the payment is that needs to be made, and that will tell us as well what the journal entry is that we need to make. So what we have to do is zero out all of these accounts. So in this case, the example that they've got, we're not yet paying the state income taxes, we're not paying the insurance, we're only paying the FUTA, the SUTA. No, we're not even paying the SUTA, we're only paying the FUTA. So this is to deposit the 941 taxes. Okay, that makes sense. OASDI, Medicare tax, and federal income taxes that have been withheld. Those are the amounts that go on our Form 941, right? So, FICA taxes payable. All of these credits pertaining to these accounts, now we're going to debit those accounts to zero them out. So FICA payable, I'm sorry, OASD, I did it again. HI payable. And then our federal income taxes payable. So think 941. All those taxes that would go on the 941, that's what this journal entry pertains to. All right? And then we've got cash that's going to go out. Again, what we do is we look at our ledger accounts. So right now we owe $228.78. We owe $53.50. For federal income taxes, we owe $170. Total amount of cash that's going to go out is the sum of all of those. So $452.28. There's our journal entry. And again, it would be posted then to the ledger. So for each of these accounts, our OASDI payable, because it's a debit this time, it's going to go over here, which means this becomes zero. Now we don't owe anything because we've already paid it. Medicare taxes, again, $53.50 is going to be our debit, so that's going to zero out as well. Federal income taxes, now we've got a debit, so this is going to zero out at this point in time, and then we've got more cash that's going out, $452.28. So now, like I said, hopefully we had some cash in there, or we've had some cash come in, because otherwise we're in the hole by about $1,750. Because we've made that payment to our employees, and then we made that payment for those payroll taxes. Now, at a different time, we probably are gonna make that state income tax payment, because remember that our schedule is different, right? The payment schedule for federal income taxes is gonna be different from the payment schedule for state income taxes. Federal income taxes, we might be making that payment, well, if it's this amount, we might be making it on a monthly basis. So by the 15th of the following month, we make that payment. But for state income taxes, we might not have to pay that. We may be able to pay it every quarter. It looks like in this case, they're probably paying it every single payday. But we've got separate journal entries for those amounts simply because we've got separate schedules, separate payment schedules for those. Again, the triggers for these, and this is the same category of journal entry, but the triggers for these are going to be the payment of those taxes. It's going to be at a different time though than this other journal entry is made. But we've got the state income taxes payable of $50. They've already done it here, so I'm not gonna. So that would zero that out. Cash, again, $50 going out. We got a lot of money going out. Hopefully we've got some coming in. SUTA taxes payable, $46.06. So now we're at zero there, but we've got to pay it. $46.06. So right now in our cash account, where's our calculator? We're in the hole. Oh. $1841.20. Cash is an asset. Normal balance is a debit balance. That means you're positive in cash. If you've got a credit balance, it means you're negative in cash. Okay. Questions about these? About this, again, this is the third category of journal entry, when those taxes are actually paid, or those amounts are actually paid. So eventually, that food is going to be paid, that $369. Now, if that's all we're incurring, we probably aren't going to have to pay that until January 31st, right? So that's just going to keep accruing that liability all year long until January 31st when we make the payment, and then it would zero out. Insurance, again, that's just going to depend on when we actually make that payment. For the next payroll, it's going to add to our wages expense, and then we're also going to have additional OASDI payable, Medicare payable, federal income taxes payable, state income taxes payable. We just do this cycle again and again and again for every payroll. Questions? That makes sense? Does it ring a bell with those of you who have taken principles or intro or taking them right now? I'm not contradicting anything that anybody has said. That's good. All right. Let's see. An employee's FICA taxes payable is $700. What amount is debited to the FICA taxes payable OASDI account in the journal entry to record the electronic transfer of federal taxes? So this is only the employee's portion. Yeah, I'd say $1,400 as well. Oops. $1,400, because each, since that's just the employee's portion, $700, the employer would also owe $700. Okay, so we've gone through the first 3 journal entries. Are you ready for the last one? The last one we make because our accounting period is different than our payroll period, or our accounting cycle is different than our payroll cycle. And I'll give you an example of what I mean by that. All right. You know, the accounting, we make a lot of different types of adjusting entries at the end of a period. One of the most common ones is depreciation, right? Because depreciation is a non-cash event. All of these adjusting entries are non-cash events, right? We're making them because we need the balance to be correct. And at the end of the period, currently our balance isn't correct. So we've got to make an entry in order to make sure that, or on an accrual basis, that our balance is correct. So again, we're not going to have any particular cash transaction that triggers this. It's just the end of, say, the end of the month, right? So let's look at the calendar. Show you what I mean by this. November's a good example. So here's our calendar for November. If we are on a bi-weekly pay schedule, and let's just say that we pay on Fridays, and we pay through, well, we'll make it easy here. Let's say we have a payroll coming up on the 1st of December. Our payroll cycle is the 20th, starts on the 20th and ends on the 1st. But we have to create financial statements as of the 30th of November. That means we've had employees that have worked 9 days. They haven't been paid yet. But we have to make sure that the expense for those 9 days is recorded in November, because we owe that money as of the end of November. We're not going to pay them until December 1st. So we have to make this adjusting entry at the end of the month to record the expense for those salaries up to November 30th. This is the last journal entry category of journal entries that we would make. So we'll use our example in a second. I'll go through this one first. So if we have employees that earns $2,400 at the end of December, but it's not going to be paid until January, and that we're looking at December. Yeah, that's kind of a clean cut this year. But if say the pay period ended on the 27th of December, but they're not going to be paid until the 3rd of December, then that means that as of the end of the month, we're going to have to record the expense for those final days. So in this case, they've got, whoops, I need to do that. $2,400 was earned at the end of December, but it's not paid until January. We're going to record that wage expense of $2,400 in the current period. That means we've got wages payable. We've incurred the expense, but we haven't paid it yet. So we're going to have these wages payable of $2,400 as of the end of the period. Now, in this case, they're not recording any of the withholding taxes because they haven't really been withheld yet. There are some, I would say though that in my experience, there are some companies that will go ahead and record those taxes because the taxes are going to be owed as well. At least the employer's portion of those taxes would be recorded because they're going to be owed at that point. So this means that all of those calculations have to be done as of the end of the period as though they were being paid, right? So you've got to anticipate and do those calculations to see how much exactly is owed at that point. So in our example for November, let's just say, so we've got Monday, Tuesday, Wednesday, Thursday, Friday. And so we've got 2 weeks there. Week 1, week 2, and then the end of our period, this is the 30th here, right? So we've got the 20, 21, 22, 23, 24, 25, 26, 27, 8, 29, 30, 1. This is payday. But this is the full pay period. And during this pay period, our employees earned, I don't know, let's say they earn total $500 a day, gross wages. Okay, so 500, 500, 500, 500, 500, again 500, 500, 500, 500. They're also gonna earn 500 on that day, but we don't record that yet. So what we have to do is determine how much have they earned so far up to the 30th, but haven't been paid for yet. So we've got 9 days at $500 a day, so $4,500, right? So we've got wages expense. So this would be on 11/30. And wages payable. So at the end of the period, we've got that wages payable. So when we actually make the payment on the 1st, we only record the $500 of wages expense. Well, you could reverse it if you wanted to, or $500. But we've got cash that's gonna go out of $5,000, right? Because we're gonna have to pay this and this. Well, if we were making a gross payment, if we weren't taking out any of those taxes, right? So how this would look is our wages expense would now be $500 for that one day. We'd have wages payable that we're gonna reverse right here, $4,500. And then we have cash going out of $5,000. Again, this is assuming no withholding has happened. We're making it simple. Like I said, the other way to do it is at the beginning of the month, you reverse that entry, and then you record the other entry just as though that first entry hadn't happened. Okay? But this would be as of the 1st of the month, you reverse it. So that, again, that's when we have a timing difference between what the accounting cycle is, the end of the accounting period, and the end of the payroll period. That is why those bi-weekly payroll schedules, even though they're easier to calculate as far as like determining overtime and all of that, because you've got your 7 consecutive days, either a weekly payroll cycle or a bi-weekly payroll cycle for overtime purposes is easier to calculate, but it's not easier when it comes to then matching up that accounting cycle with the payroll cycle. If, however, we're paying on the end of the month, at the end of the month, say we pay once a month and it's on the 30th of the month, and we pay all the way through the end of the month, like that's the end of our pay period, then we don't have any adjusting entry to make because we're actually paying it. what we owed as of the end of the month, right? Same thing if it's semi-monthly, we wouldn't have any adjustment to make on the first one, and then we wouldn't have any adjustment to make on the second one either. That's provided our pay period is the same as our pay date. So oftentimes that's not the case. Employers will, small employers will do that. They'll end the pay cycle on the same day that they pay. But a lot of other employers won't do that. They'll end the pay cycle maybe a week earlier, so it gives them a week to process payroll. It just depends on the employer, how they want to do that. Questions about this? Does that make sense? So we've got our 4 journal entries. So another type of end of period adjustment might be for different benefits that have been earned. So like in this case, vacation that's earned but hasn't been taken yet. You would make that entry if vacation pay is required to be paid out if it's not taken, right? So you'd want to record that. That's not always the case. And in Iowa, they don't have to pay you for any accrued vacation time. A lot of employers do. Maybe they don't for sick days or stuff like that, but they do. PTO would be an example of when you would make that adjustment as well. So that would involve some calculations to figure out in total how much vacation has been earned by everybody as of the end of that pay period. But it would be the same type of entry. So you've got your debit for vacation benefits expense, and then your credit for vacation benefits payable. That gets a little weird in that if that vacation is not taken in fairly quickly, pay rates could change. So that amount might be different, right? So you'd have to do a couple of gymnastics in order to get that zeroed out correctly. As it mentions here, so post-retirement benefits and healthcare pensions would also require adjusting journal entries as at the end of the accounting period. Questions? So once again, those would, so each of these journal entries would then be posted to their ledger accounts. So if you remember, our ledger account had a balance of, what was it, $1,845, $1,850, something like that for wages expense. Now we would be posting $4,500 additional to that wages expense, increasing that ending balance. And then of course, at the end of the period, the end of the accounting period, all of the amounts in the ledgers are then transferred to the trial balance. You actually do that before you make the adjusting entries, because those adjusting entries are made after the initial trial balance is made. And then we have an adjusted trial balance that's done after all of our adjusting entries have been made. You use that first trial balance to determine what adjusting entries need to be made. I don't know if you've gotten that far in your accounting classes yet or not, but then that adjusted trial balance is what's used then to create the financial statements. And ultimately, creating the financial statements is a piece of cake because all the numbers are already there for you. All you're doing is extracting them, putting them in the right spots on those financial statements when you're pulling it from the adjusted trial balance. Questions? Above 17? No? All right. Let's see here. things that we have done. Talked about those payroll registers and the employee earnings records again, and the information that's on them. We talked about different types of deductions, voluntary and involuntary. These are amounts that are withheld from employees' pay. We looked at those 4 categories of journal entries that have to be made that pertain to the to payroll. We posted them to our general ledger accounts, those T accounts. We looked at the journal entry for recording the payroll tax deposits and the journal entry for the end of period adjustments. Questions? No? No questions, really? All right. That concludes the lecture on chapter 6. Now, you have, so December 7th, a week from Thursday, is when chapter 6 homework is due. I think what I want to do is, have you guys started working on your chapter 6 homework yet? No? Some of you yes, some of you no. Okay. I tell you what, let me give you a chance to start working on some of that homework. Let me get my schedule up here. So, let's use Thursday to go through homework, okay, for chapter 6. So that gives you a couple of days to start digging into it. I'm trying to think. So your chapter 5 homework was due Sunday, so you don't have any, that should be done. So you can focus on chapter 6. Come back on Thursday. I'm gonna let you go a little bit early today, believe it or not. I figure, that's 20 minutes, I figure I've probably kept you over for at least a total of 20 minutes throughout the semester. But I'll let you go. Start working on chapter 6, and then we'll go through homework on Thursday. Okay? Sound good?